I'm delighted to be welcoming you at the end of this first week of COP26 to an exciting panel on transitioning finance and financing transition. With 5 of our GHS at COP26 partners, Aviva, DLA Piper, abrdn, Phoenix and Morgan Stanley, giving us an opportunity to highlight the key insights from this week when it comes to professional and financial services and their role in the net zero transition. I'm Catherine McGuinness, Policy Chair at the City of London Corporation. We know that the scale of the net zero challenge and the investment required is huge. In achieving this, financial and professional services will be key. Aside from being the governing body for the Square Mile, we also represent the financial and professional services sector. And it's my pleasure to introduce our panellists today. Zelda Bentham, Group Head of Sustainability at Aviva, Navindu Katugampola, Global Head of Sustainability at Morgan Stanley Investment Management, Eva Cairns, Head of Climate Change Strategy at abrdn, Sindhu Krishna, Head of Sustainable Investments at Phoenix, and Bryony Widdup, Partner at DLA Piper. Now, we only have 45 minutes for what I know will be a very full exchange, and I'd like to start by asking our panellists, it's been a week where finance and business has been very much to the fore. I think we're starting to call it the Finance COP. We've had a number of significant announcements, which, if they're actioned, could really have significant impact. And I just wonder, as a starter, if there's any particular initiative which you'd like to highlight. Perhaps I could start with you, Sindhu.
Yeah, sure, Catherine. I think I'll pick the one which was recently announced in terms of the transition, or companies disclosing their transition plans. We are somewhere there, I would say, in terms of, we've started the journey, I would say, on that with the TCFD, the Task Force for Climate-Related Financial Disclosures, where companies will be providing their strategy, the governance, risk management, metrics and targets. So this is, again, putting us further ahead from my perspective in terms of sharing the transitioning plans, something that we've started on our own journey in terms of setting our interim targets, coming out with the details in terms of how we actually do that. So I think as companies provide more and more details of not only the commitments, but also walking the talk and how they're going to get there, I think that's useful not only for us as decision makers, but also provide the trust which is very much needed in that we're not only making pledges, but also committed to delivering that.
Thank you very much, Bryony.
Zelda,
that's a great start.
It's all right, Catherine, don't worry. I think for me, when I reflect back on previous COPs that I've been to, the Paris COP and the Bonn COP, even in Paris, when we were talking about finance at the COP, it was public finance. There was not, you had to say, I'm here from private finance, because that was never discussed. And there is such a sea change in that now. There is that recognition that private finance is vital to the transformation and the transition to a low carbon future. So I think, as well as the announcement in respect of the mandatory climate transition plans, which again, very vital, it's the how far we've come and what else can we do going forwards.
Lovely. Thank you. Eva?
I would probably highlight the GFANZ commitment that a lot of people are talking about. 130 trillion committed to net zero. And people are saying, the finance is there and we can get there with that significant amount, which represents 40% of assets globally. But I would highlight 2 things. The first one, people are asking rightly, what does this really mean in practice? And the industry is working hard to actually define that and figure that out. So I think it really shows that willingness of private finance to be part of the journey. We ourselves are working through what does net zero aligned finance looks like. And how do you make sure that the way you invest is for net zero in the real world and not just decarbonising a portfolio? And the second point that's important is that most of these targets or commitments are still on the basis that policies will move in that direction as well. And that you can't just do that with finance without the policies moving and aligning with 1.5 degrees. And on that, we have seen some positive, encouraging announcement, but are we there yet? We're saying we're keeping the 1.5 goal alive as part of this COP. Not yet, I would say.
Great, thanks very much. Navindu?
Certainly, I mean, I agree with all those three great examples. And maybe just to zoom out a little bit, one of the things that I found really encouraging about this COP is we're no longer debating the endpoint. And that's actually quite a meaningful change. We all agree that we need to end with a net zero economy. The only debate really is how quickly we get there and the modality of how we actually deliver it. So I think that is encouraging. A number of the announcements, whether it's around deforestation or methane reduction or transference away from coal and onto renewable energy, are extremely encouraging. But at the same time, there is also a conundrum inherent in that, because a lot of these aspects of these very eye-catching announcements in aggregate are very piecemeal. And we need to start thinking about how you connect some of these dots. It's like when my son plays with his Lego, you've got the little building blocks, but how do you put it all together to deliver the ultimate outcome? So that's where I think, picking up on some of the themes that the other panelists raised about the interface about private finance with public initiatives becomes very interesting. And I'm particularly enthusiastic about, especially with developing countries, and the role that developed markets and capital within developed markets have to play in actually mobilizing the transition in developing countries.
Thank you. And Bryony?
So I'm not sure if net zero is the end of the journey. I think net zero by 2050, but ultimately going beyond that. And that conversation, I think, is really interesting in terms of, well, what is the beyond that moment, and how do we ultimately begin to integrate nature in the way that's needed with net zero to move beyond that into actually beginning to take carbon negativity, moving beyond net zero. So I think that's a really fascinating aspect of the conversation. But I do just want to pick up on the ISSB announcement, which I know we were all expecting. It wasn't sort of, a big surprise. But I do think that's just got a really key part to play in how we can roll out net zero. And you mentioned trust, in a trusted and accountable way. We really need those internationally acceptable standards to do that.
Yes, I think that's one which may not get quite as many headlines, but actually is a really profound development. Great, thank you. Zelda, we've just had a session on insuring the uninsurable, and I wondered what your views are on the unique role which insurers can play in the transition to net zero.
Yeah, I think, I believe that insurers do have that unique role. And it was back in, 2012, 2013, that one of the UK government ministers said that insurers are the canaries in the coal mine when it comes to climate change. Because we take the science from the scientists and we turn it into everyday risks for, everybody who wants an insurance policy. And that's particularly the case in terms of climate change, physical losses. And we're there as a risk transfer mechanism, so when things go wrong, we'll pay out. But I think that misses a vital bit of the role of insurers. And we're also there as risk experts. So even before things are designed and planned and built and manufactured, insurers need a voice at that table. Because we can say, this will reduce your climate risk, this will reduce your physical flood risk, or excuse me, or impact from extreme weather. So we need to work more on a cross-sectoral basis with construction, with manufacturers, to understand what's needed for the transition going forwards and how we can reduce the risk, loss prevention, and then build that resilience for a transition to a net carbon economy going forwards. So I think that is the two unique ways of providing that safety net, but also of being a risk expert when it comes to climate change.
Thank you very much. And Navindu, I'm going to turn to the financial services sector now. Can you tell us how how financial services can ensure that that real-world impact results from its climate change strategies, and in particular, how can the sector avoid greenwashing, and do we have the right tools to deal with that?
Yeah, certainly. And I might pick up here on something that Sindhu mentioned in the opening remarks, and maybe to, again, go back to with Morgan Stanley, where we started when we were thinking about sustainability. So we set up our global sustainable finance team back in 2009. So the concept of a green recovery, a sustainable recovery, we were solving for that in the last crisis, coming off the back of the financial crisis. So it's something we've been thinking about for quite some time. And we were the first US bank to pledge to get to net zero in terms of our financed emissions by 2050 in September last year. And then going back to my building blocks example, thinking about the pieces of the puzzle that are inherent within that to avoid greenwashing and actually to plot some sort of roadmap forward. And really, to my mind, there are three pieces to really ensure that any sort of climate or net zero strategy have credibility. The first piece is measuring. You have to measure what you're actually trying to solve for. So again, we were the first US bank to sign up to the to PCAF, the Partnership for Climate Accounting Financials. And essentially, we have been using our involvement there to define the metric we're solving for in terms of financed emissions. So essentially looking at, across our lending book, the proportion of capital that we provide through lending, and therefore what proportion of a company's emissions, scope 1, 2, and 3, will be attributable to our financing. So that's step one. Measure what your actual footprint is. Step two for us is manage. So once you've worked out what metrics you're solving for, how do you chart a credible route forward to get to the end point? And here we joined the Net Zero Banking Alliance and have been working very closely with them, defining on a sector-by-sector basis what those routes should look like. Because sectors will, first of all, there's a materiality aspect to it. And we've set targets for auto manufacturing, for power, and for energy, the sectors that are most material when it comes to carbon emissions. And we've set targets for each of those sectors for the next 10 years to 2030, based on the International Energy Agency's scenario analysis. So essentially defining what roadmap we're going to manage to. And then ultimately going back to Sindhu's point around TCFD, it comes back to reporting. So we need to have, there's no point of, Morgan Stanley is one example of how you could do it, but there's no point each of our different firms plotting, choosing different methodologies to get to a particular endpoint. We need to have a consistent, comparable, objective framework, which I think we'd all probably agree TCFD offers us, that we can all report to, which allow clients, customers, the general public, investors, to observe and compare. So we've been producing TCFD reporting, and we continue to do so, and that'll be our mechanism to report. So I would just clarify that having a very simple framework to measure, manage, and report, and have transparency on each of those three is the key to avoid greenwashing.
Yeah. Thank you very much. And Eva, looking at asset managers, how should they incorporate climate risks in their decisions?
So I think that is exactly the first step, and you talked about measurement, and I fully agree. You need to be able to really show that you've done the research, you've got the data and the tools to incorporate climate change into your investment decision making, to be able to transition finance and finance for net zero, for example. And climate change really impacts every region and sector and asset differently. So we need to build that understanding and take a forward-looking view. That's one thing we believe is quite important. So one of the things we've done, published this year, is a climate scenario analysis piece that looks at how 14 different climate scenarios and how different regions and sectors and assets are impacted across these scenarios. And we've also assigned probabilities to them to get a kind of mean probability weighted view. And that is really insightful for us because it quantifies ultimately across different regions and sectors what the impact would be on the assets that we invest in. And particularly when we think about developing portfolios that are aligned to net zero, you need to have the tools and the research to identify the risks and opportunities. Opportunities is a really important part of that. And so this kind of analysis can then show you, for example, a stringent energy transition world, you look at the utility sector, you see a really big diversion of companies that are positively impacted and very well positioned going into renewables, and then others that are negatively impacted because they're not that well positioned. So that's a great starting point for starting to incorporate that into your investment decision making. But then the second part that's really important is to understand the transition plans of those companies. And that links to what Sindhu said at the start with the announcement that this will be mandatory in the UK, which I think is a great step, because we need transparency on, you identify that companies might be negatively impacted, but actually they have put the strategies and have got credible transition plans in place. Not just a long-term goal that is vague, but starting to make change today in their capex and investment plans. And so we need to complement the quantitative analysis that we do with more active research into transition strategies and transition plans, and also combine that with actual engagement, discussing these things with the companies we invest in. And I think that is then quite a powerful combination for incorporating climate change into the investment process.
Thank you very much. I'd like to pursue this just a little further. I'd like to ask you, Sindhu, what would you say is the right approach to follow and the challenges involved in bringing investments to net zero?
Sure. I think the first thing I'd say is there's no right approach, because this is everybody's unique journey, and they have to. I mean, there are frameworks, there are methodology, standardization, but it is for every journey, for every company to reflect on its own journey and set that for the company itself. So when we started this last year, we started with 3 pillars. We said we're going to decarbonize, we're going to invest more, and we're going to be responsible stewards. We're going to engage for change. So those were our 3 main pillars. And when I look at the first pillar, that starts with the decarbonizing journey, which was, the points which was mentioned. Where are you starting from? So you're saying you're going to decarbonize. What's your starting position? And we all know net zero is not one big jump to 2050. There has to be interim steps. So what are those interim steps? Where I am now, where I want to be in the next 5 years, in the next 10 years. And I think that helps making it real for management, for senior stakeholders to take accountability as well. So we have the interim targets, and then the how, working with asset management partners and other stakeholders to start moving those investment portfolios on that journey. In parallel, we invest more in the opportunity side, and also the key tool for us with the assets that we have under our administration, the size north of 300 billion, is we want to engage for change. The push we can, use our voice to bring the change which is necessary in this climate. I think in terms of challenges, it is a constantly moving landscape, whether I can fix the metric today, but there will be a new best practice, a new standard in a few months' time. The same applies for the methodologies. We're all working to create those standards, and the goalpost itself moves, so you have to be agile, you have to be responsive to those. And we all need to take our stakeholders within the organization on that journey. So I think that itself, you've been used to doing things in a 2-dimensional way of risk return, introducing and baking this 3rd dimension in, and taking everybody on that journey, be it clients, internal colleagues, investors, all the stakeholders, transparently, robustly. I think that is the challenge.
Thanks very much. And Zelda, how do we generate attractive investments for investors?
Yeah, in a net zero world, or aligning ourselves to net zero, it's an interesting one. For Aviva, we set a net zero target of 2040, and therefore, because we are going ahead of UK government, because we are going ahead of the economy, we actually have to drive net zero, as well as support it from an insurance point of view. So our coverage of our investments in terms of net zero is not only our shareholders, but it's our with-profits and it's our policyholders as well. Our policyholders' pensions, individuals, and investments aren't interesting to some people. Don't get it myself, but still. And so how do we approach those customers? How do we make sure that they're engaged? And for some customers, it's never going to happen. So we put in place default ESG investment opportunities for them, so that we know that those portfolios are decarbonising and are helping transition, regardless of whether the individual customer knows that or not. But there are some really interesting investments out there in terms of how we engage with those companies and how we translate and communicate that to our end customers. What are we doing to help those companies that we're investing in to transition? how quickly are they transitioning, what happens if they don't transition, and some customers are interested in that. We're looking at also different ways of how we can generate different kinds of investments. So things like commercial loans, where you can set an interest rate, but then put in place some sustainability goals, some carbon reduction goals for those companies. And if they meet those, then we'll say that we will reduce the interest rate on that particular loan. So that means that we're helping those companies transition as well. And again, something interesting for our customers. And then there'll be those customers that just aren't interested in the transition itself. They're interested in the end goal and the net zero. And we have to make sure that we're providing investments that are suitable for them. So fossil-free funds, for example. But it depends where you come from. And I think the most important thing is to understand the values of the end customer and to match the investments that we're providing for them to those values.
Can I add a point, actually, if I may? So I think Zelda touched upon some really important aspects of this when thinking about it from an investment standpoint. But by the same token, you don't necessarily have to distinguish between investing and climate investing. Managing climate risk is an inherent piece of your responsibility as an asset manager. If I think about the fundamental tenets of investment, it's about reducing, optimizing, mitigating risk, but also seeking to generate alpha by identifying opportunity. And we think about what climate presents. It is both risk mitigation and alpha generation opportunities in different sectors. Different companies within individual sectors may be suffering from headwinds when it comes to climate change. Some companies might be more exposed to higher carbon prices because of excessive reliance on fossil fuels, for example. Other sorts of companies may benefit from tailwinds. So if you think about, say, auto manufacturers and how they are positioning their business to benefit from the transition towards electric vehicles, well, some may be further along on that transition than others. And if you can identify the ones that may be more successful, that could be an opportunity to generate alpha. So even if you are not necessarily explicitly trying to solve for a climate outcome with the portfolio, it's still inherent on asset managers to work out how climate change is relevant to the investments we're making in a risk-return framework.
Thank you. Did you want to come in on that as well?
No, I was just... no, that was fine.
Right, great. I'll turn to you then, Bryony. From your perspective, what needs to change in financial markets in terms of products and technology, for example, to facilitate the net zero transition?
Yeah, I mean, we've just heard, haven't we? I mean, how many different products or, proposed approaches have been mentioned. So I think that the thing to start with is that financial markets and financial services and products are already changing, have already changed. That we're not starting afresh here by any stretch of the imagination. But I think, we know that it's currently not sufficient and there are barriers to scale. It's not accelerated enough, it's not quick enough what's happening. And there are refinements and improvements and learnings that we're gaining from the initial products that have been implemented across portfolios and with clients, with borrowers, and in the bond market. So we've got refinement work as well on existing products. So I think in terms of existing products, maybe we can talk about how do we integrate better ambition? And that's, you mentioned greenwashing earlier, and that's around the greenwashing point. How do we ensure, for example, that the sustainability-linked loan angle that Zelda mentioned is sufficiently ambitious that you're not benefiting somebody's effective business as usual scenario? So, ambition is a really key word, I think, in this area. And then connecting capital with outcomes. And very much, we've heard that in this conversation. How do we improve our existing products via information flows, via that measurement, monitoring, verification, to ensure that the application of the capital is accountable when it comes to the outcome? I think that's another improvement area. And finally, the levers for failure. So Zelda mentioned, for example, the reducing the interest rate if you succeed. But at the moment, what we don't really have, as far as I'm aware anyway, in the products that we deal with, are real teeth around failure. And what does that look like? You know, financial penalties may well not be the answer here. So is it some sort of success published success index, you know, something that gives that motivation and alignment towards achieving. In new products, we're on a transition finance panel, and we haven't actually mentioned sort of those transition products, you know, the products for the hard to tackle. So green is great, but we're also talking about moving the dial on brown. So how do we develop acceptable transition finance products at scale? You know, we've in our legal services industry, we've got a challenge at the moment with take-on, questions around take-on, sustainability measurements in take-on for clients who are perhaps, you know, historically not sustainable. But what if it's a historically not sustainable client doing a really sustainable thing? You know, there needs to be nuance in that. We've got to get that right. So being able to finance in a transition way, in a transition-focused way, is really, really important on moving the dial on brown. And a couple of other things. I mean, I think we need to integrate better at the moment the fintech space with what needs to be achieved on net zero and on climate. And they probably have a lot of solutions around the MRV, the monitoring, reporting and verification piece, the data piece within those products. I don't think we've done enough on that. And finally, I think we should mention the new models in supply chain finance. One of the things that gets talked about a lot is the Scope 3 emissions challenge, or how do you get from the motivated, activated companies, you know, who are often the public ones who are being forced to be accountable, down into those smaller businesses, you know, right through the economy. And probably some of the levers in that are new supply chain finance products that help to deliver this net zero purpose right the way down through the value chain.
May I add to this transition finance, actually, because that's also a key thing that we try to get the message across, what I said earlier, that you need that real world decarbonisation, not just in your portfolio. So that means you don't just hold low carbon companies in your portfolio and the carbon footprint looks great and the temperature score looks great, but that you're actually allowed to hold companies that may be carbon intensive today with that forward-looking view on where they will be in the future. They might be innovating to help the whole sector decarbonise. They might be leading that sector, but might be in really difficult to abate sectors like cement and steel. And then you look at sometimes the temperature scores of these companies and they are 4-degree aligned, and you think that will just encourage me to take them out of my portfolio. And I think we need to be really careful on, when we look at data, what unintended consequences this might lead to when you make investment decisions on that basis. And Sindhu, I wonder what your thoughts are on this. How do we strike the right balance between engagement and divestment?
I think this beautifully stitches the other points which were made thus far. So I'll probably approach it as look at it from a different perspective and come to this from the aspect we've been discussing. So engagement is key. So this is not just engagement with the end companies. We've talked about that. I'll come to that in a bit. But also the entire ecosystem in which we operate. So I speak as an asset owner. So we're a savings and retirement business. So our immediate stakeholders is our asset management partners. Are they doing enough? Are we hold them to account enough to say, are you speaking to your investee companies? Are you voting correctly? Are you voting for climate reasons? Show us the evidence. So as an asset owner, we can influence a whole ecosystem, and we want to use that opportunity to bring change throughout the ecosystem, at the end of which is also the investee companies themselves. So we've raised the game, and we've raised the game for all our asset management partners. So greater transparency in terms of how we assess them, the due diligence process. So it starts from them to various stakeholders that we work with, so engaging across the board. And then going to the investee companies themselves, Absolutely. We want to be, going back to the point you raised previously, the real world change. We don't want an investment portfolio which is net zero where the world is absolutely not. So we want the portfolios to be on that path. And that's what our customers ask of as well. So when we do customer surveys, our customers, 85% of them say you have to invest responsibly, irrespective of which label you sell me. I want you to invest in a responsible way. So this is moving everything we have. So we don't want to exclude sectors. We want to push everybody on that journey because there are impacts from a social perspective, from societal perspective, communities, if we just start pulling our money out of certain sectors. So we want to use our voice to bring change. So it's absolutely engagement through the way. But we have the stick of divestment, which is the last resort.
Can I add something to that? Actually, I think Sindhu, I think you've nailed it. The debate around divest versus engage, it's not straightforward. And the three critical things for me are, first of all, smoothing that transition. If the transition is excessively bumpy, it's going to cause, frankly, quite significant problems. I mean, look what's happening in this country right now with energy prices. And there is an element of that that's due to perhaps failure to invest in infrastructure around, say, natural gas, for example. So that's a debate that we have to actually tackle. The second element of this that Sindhu touched upon is just transition. And we need to be careful about applying a divestment strategy that unfairly prejudices those economies, those countries, those elements of the population that may be more vulnerable and actually may actually suffer the consequences of that transition more acutely. And the third piece is really defining what the goal of engagement is. And I think the critical piece here, when we're thinking about that divest versus engage spectrum, is actually defining clear outcomes or targets or objectives for a dialogue and engagement. And we're looking at a particular sector or thinking about a particular company, asking ourselves in our role as a steward of capital, or as, in the case of a bank, as an intermediator of capital, whether active dialogue, advisory dialogue, encouragement, advice, and a real focus on an evolution of business models can actually bring about more meaningful change than simply divesting.
I think I must say, explaining the transition is one of the biggest challenges that we have when it comes to explaining to the ordinary public, to the people who'll be marching through Glasgow on Saturday campaigning, explaining why we have to do this carefully and with that concern to justice, I think is really one of our biggest challenges, besides explaining the greenwashing point. But I want to actually also look at some of the partnerships that we need to build, people-planet partnerships. What do we need, Bryony, would you say, from other sectors of the economy, for example, government, regulatory bodies, corporates, and so on, and of course, lawyers and other service providers,
Indeed.
Very important, to help financial services provide greater impact?
Yeah, I think there's been a big realisation around this COP, that the how-to of the implementation job that we're at this, very near the start really of that journey, is going to take enormous collaboration. And it's collaboration in non-traditional ways. It's collaboration between private sector and NGO, between, the groups, the protesting groups, and between and then the companies, and perhaps one of the things I heard said earlier today was energy companies aren't here, traditional energy companies aren't here, but that conversation needs to be opened up, fully engaged in a collaborative way in order to achieve what we need to do here. So the scale of what needs to be achieved, and I think this was highlighted as well in David Attenborough's speech at the start of the week, that if we've destroyed the place working apart, there is hope that coming together we can succeed to fix the problems. So what do those collaborations look like? I mean, we need collaborations with our technology and engineering industries. You know, we need financial services and engineering coming together to work out, well, where does the finance need to go when we're implementing this net zero plan? We need the scientific community to be heavily involved. We need the academic community. We need the policymakers and the regulators, of course, although I think there has been a bit of a sense this week that actually the other collaborations, maybe the science, the academic and the private capital collaborations at the moment have gone beyond the regulatory and policy environment. And actually, that's not necessarily seen so much at the moment as a necessary enabler. I mean, you know, Zelda was saying Aviva's gone for a 2040 date. So, you know, going beyond really perhaps policy and regulation at the moment is quite a theme, and that's extraordinarily powerful. And then the other big thing here, and it was mentioned earlier, is developing new innovative financial models in this public-private funding partnership space. Because we've got blended finance models, we've got the ability to develop dynamic risk-sharing structures that can bring risk-averse private capital into probably much more risky than usual investments, in particular when we're talking about moving all this money into the developing world. But we don't do that at the moment at this type of scale. And people are not familiar at this type of scale with those models. And, you know, impact, which is the area where this has been used historically, has been much, much smaller and niche. And now this is going to come hugely mainstream. So I think the innovation in that public-private partnership funding model is going to be really key over the next few years.
Yeah. Thank you. And Eva, what do you think are the crucial next step actions required from the financial services sector to support?
So I think, as I mentioned at the start, we've seen this big 130 trillion, and everybody that was part of that, and that includes ourselves, working out, you know, what net zero, investing for net zero means, what the targets that we've set, 50% carbon intensity reduction by 2030. We now need real clarity on what that means. What is the baseline? What metrics are being used? Carbon intensity, there's different metrics. You can use revenue, you can use enterprise value. And if the industry does this differently, and at the moment, unfortunately, they do, even though we have great frameworks like TCFD, you look at the detail of the really detailed questions, people will use different approaches, and that'll make it quite difficult to compare. But I think the next step is to provide that transparency. We want to do a kind of, this is our target setting framework, that's the baseline. We're probably going to measure a number of metrics to just demonstrate, provide transparency of some of those real challenges, and also that the assets won't stay constant. So actually being able to tell that story. So I think demonstrating how it's going to be implemented in practice, and also being very, very transparent about the assumptions and the conditions. As I said, most of these say we assume policies will also align with the 1.5 trajectory to enable us to do this. We assume our clients will also go on that journey, and being very transparent about that. And hopefully in 12 months' time, showing progress, monitoring against that baseline, and hopefully in a year's time we'll then have the announcement, and here is the progress against the target we set last year.
Thank you. And Navindu, I know you've been thinking about this. 30 seconds on next steps?
Yeah, I'll say two things. First of all, primarily financial services act as an intermediator of capital, from asset owners to those that need, companies that need the money. To Bryony's point about products and product innovation and development, one reason that I'm cautiously optimistic is just the sheer explosion we've had in things like the sustainable bond markets, the green social sustainability bonds that are likely to top $1 trillion equivalent of issuance this year. So that growth of products as an intermediary of capital that help deliver solutions. The other piece that gives me cause for optimism is as that asset owner demographic evolves, we did a recent survey at Morgan Stanley where it found that 99% of millennials would want to consider sustainability in their investment decisions. So as those asset owners evolve, as capital flows towards a new generation of asset owners, I think we'll have more of an effect as an intermediator's capital delivering sustainable solutions for companies as well.
Great, thank you very much. Look, you've been a fantastic panel. Thank you very much, all of you, for your insights.